Peter Cardillo is with us from Spartan Capital Securities. Peter, hi. Thanks much for taking time out to chat with us. Just want to understand what has been, taking place over the last two sessions on Wall Street. There's a massive risk aversion happening amid investors. They are just, in a major sell-off, seem to have entered a major sell-off mode. What is your view on what is going on Wall Street? By when do you see things stabilize a bit, given the macroeconomic situation and also about the markets?
Well, to begin with, obviously, investors are quite concerned over the trade war and, of course, rising bond yields. And that's been the real reason why the market has decided to do what it's doing. And, of course, these are valid reasons. And I say they're valid reasons because we're soon going to embark on the third quarter earnings season, and I think that we can safely say that some of the industrial companies might come in with disappointing earnings in a sense that they will have to take a hit due to the tariffs. And so I think this was probably the main concern for investors, and that's what really triggered this major sell-off. Now, of course, rising yields are never a positive for the market. When yields rise and the Fed becomes aggressive in raising rates, obviously, the market always reacts with a negative tone. But we have to realize that rates have been going up and are going to go up for the right reasons. Yesterday, we saw the CPI basically came in a little less than we were looking for and less than what the street was looking for. And as a result of that, this just simply means that there's really no inflation that would cause the Fed to take it to be aggressive. But so that indicates that the Fed is raising rates because the economy is strong. The economy can withhold rates going back to normality so that they can prevent a burst of inflation.
Peter, historically also the month of October has seen a massive history of sell-off over the past few years as well, over a longer period of time also. But what I want to understand is with the earnings season starting out, do you expect the earnings to provide would they be able to provide the right amount of fillip required for the market at this point of time, or do you see concerns around volatility, concerns around the macroeconomic macroeconomic data and macroeconomic triggers to weigh on the sentiment for some time?
No, I'm not too concerned about the macro data. I think the economy will continue to show some good numbers in the coming months. I don't see any reversal in trend in terms of economic activity. But on the earnings, I think as a whole, we'll probably have a good earnings season. But again, as I said before, we're going to see tariffs begin to impact, and that's why the market, I think, did what it did, in spite, of President Trump's pointing the figure to the Federal Reserve. I think it's a fear factor, and that fear factor might just be amplified during the earnings season.
And Peter, we mustn't also not touch upon the fact that how EMs and also European markets stand to be affected by what's happening on Wall Street now, with the Fed all set to hike interest rates in the next couple of months as well, with the crude oil being a big concern. All of these factors are playing, the devil all across the world. So how are you reading into the emerging markets right now? Would it be a prudent idea for somebody to, wait at this point of time, have a wait and watch approach, or is it a better idea to completely flee from risk and settle for bonds or settle for, commodities at this point?
Well, first of all, whether it's the emerging markets or even the American markets or the European markets, I think one needs to be prudent. And I think, a defensive position is probably a good bet at this time. And I've been saying this for quite some time now. But in terms of the fear factor gripping the emerging markets and Europe, which has not really been performing that well, is simply due to the fact that there's no doubt that the United States can hold out for a sustained period of time if there is no deal with China, and if the China war should expand. But that doesn't mean that there's not going to be pain for America as well. There will be. But of course, if we catch a cold, it's very possible that the emerging markets might get pneumonia, and Europe might get bronchitis. So I think that's the reason why we've seen the rout in Europe and in the emerging markets more negative than we saw here in the States up until a couple of days ago. Of course, we sort of played catch-up since the indices were down rather sharply over a short period of time.
Thank you, Peter, for joining us this morning and giving us your take on about the global sell-off.